Rising COVID-19 case numbers, a slowdown in the economic recovery, and political uncertainties weighed on risk assets recently. US equity markets in particular came under significant pressure in September due to a sharp setback in the technology sector. The uncertainty among investors has increased again, and hedging costs remain historically high. Due to the upcoming US elections, this is likely to remain so in the near future. The economic outlook improved significantly over the summer months. Macro data developed better than had been expected in spring. However, this positive momentum slowed at the end of the third quarter. Purchasing managers' indices revealed difficulties in maintaining the recent strong momentum, especially in the service sector. The setbacks of the PMI indices in the service sector are probably directly related to the COVID-19 case numbers, which are rising again. In Europe, case numbers are again close to the April highs, and investors fear stricter containment measures, which could stall the economic recovery. However, governments are still trying to limit restrictions locally in order to minimize negative effects on the economy. The damage to consumer confidence should therefore be limited, and we regard the current weakness in some indicators as a pause rather than the end of the recovery. Investors had hoped for an expansion of quantitative easing measures following the presentation of the Fed's new policy framework at the end of August. However, the restraint at the September meeting does not mean that the Fed has exhausted its monetary policy measures or changed its strategy. For although the Fed has been rather cautious of late and pointed out the necessity of fiscal policy measures, it will stand ready if necessary and thus continue to limit adverse risks. Against this background, credit markets should remain supported. Equity markets have come under increased selling pressure recently. Especially in times of high uncertainty, investors want stable and predictable profits. In this respect, cyclical sectors are currently still at a disadvantage. Corporate profits have fallen by around 30% this year. The recovery from this dramatic decline will continue, but will probably be unevenly distributed. Some sectors will find it easier to adapt to the new economic reality than others. Technology and healthcare companies remain at an advantage in this respect. At the regional level, we remain overweight in Europe. The region has catch-up potential, and in the medium term, fiscal policy measures should have a positive impact, despite rising COVID-19 case numbers and political uncertainty regarding the UK's withdrawal from the European Union. The diversified character of European equity markets offers attractive options for the next leg of the economic recovery. The crucial question for investors is whether the recent decline in share prices is merely a healthy correction following a strong stock market rally, or whether it is the beginning of a sustained period of weakness. We assume the former. The recent turmoil in capital markets shows no signs of underlying stress factors. Although equity market volatility is likely to remain elevated, we remain constructive and expect the cyclical recovery to continue. As emerging market regions in particular should benefit from this, we remain overweight in the region. In the fixed income segment, we have recently reduced investment-grade bonds with high duration, as we expect yields to gradually rise, but remain overweight in high-yield and emerging market bonds. We also remain overweight in convertible bonds due to their favorable risk profile. In the coming weeks, the US presidential election will be the main focus for investors. The recent past has taught us that such elections are highly unpredictable to the very end and perhaps even beyond that in the current situation. Much more important for the financial markets than the outcome of these elections, however, is whether the global economic recovery, which is still in its early stages, will continue. In our view, both monetary and fiscal policy in most countries will continue to support the recovery over the coming years. It should therefore be worthwhile taking advantage of any periods of weakness in financial markets in the fourth quarter to buy the dip in order to increase the level of risk in portfolios.